Your spouse is your partner in life, your partner in crime, and apparently your partner in death, at least according to the insurance industry. Today, we're diving into joint life insurance policies. And trust me, this one's more complicated than your first tax return as a married couple. So what exactly is a joint life policy? It's basically one insurance contract that covers two people, usually married couples, and pays out either on the first death, called first to die, or the second death, called second to die, depending on which flavor you choose. Now, here's where it gets interesting, because the insurance industry sold this product like it was the ultimate romantic gesture. One policy, one love, one premium. But just like a joint checking account, what sounds efficient on paper can get messy when real life walks through the door. The original appeal was pure math. One policy is almost always cheaper upfront than buying two separate individual policies side by side. And in the 1980s and 1990s, when estate planning for wealthy couples was all the rage, second to die policies were basically the hottest ticket in every financial planner's briefcase. But here's the quiet irony nobody talks about. That cheaper premium can become a trap if the relationship doesn't outlast the policy. Divorce rates hover around 40 to 50% in the United States, and untangling a joint life policy mid-marriage can feel like trying to split one pair of shoes. Let's talk about first to die policies first, because these are the ones most middle-class couples actually consider. The idea is that when one spouse dies, the surviving partner gets a lump sum to replace lost income, pay the mortgage, and keep the household running, which honestly sounds reasonable until you realize the policy then disappears, leaving the survivor uninsured and potentially uninsurable. Second to die policies, on the other hand, are built almost entirely for estate planning purposes. They pay out only after both spouses are gone, typically to cover estate taxes or leave a legacy for heirs. These can make genuine sense for high net worth couples whose estates might trigger significant tax liability. But for the average couple worried about next month's mortgage, a second to die policy is about as immediately useful as a parachute stored in your attic. Here's the misconception that costs people the most money. Couples assume joint policies are always the budget-friendly choice without running the actual numbers against two individual term policies. In many cases, especially for younger, healthy couples, two separate 20-year term policies can be nearly as affordable while offering dramatically more flexibility, portability, and protection. History has shown us repeatedly that financial products marketed as convenient bundles often prioritize simplicity of sale over complexity of need. Think about it the same way you'd think about a bundled cable package you're paying for channels you'll never watch, just because separating them feels like too much work. The practical lesson here is to treat this decision like a spreadsheet, not a romance novel. Get quotes for both options, stress test the divorce scenario, consider your health trajectory separately, and ask your insurer specifically what happens to the surviving spouse's insurability if the first to die benefit is triggered. If one spouse is significantly less healthy than the other, a joint policy can actually work in your favor because the underwriting blends both risk profiles together. But if both of you are young and healthy, you're likely subsidizing a product structure that benefits the insurer more than it benefits your household balance sheet. The behavioral trap is real. Couples avoid having the "what if we divorce" or "what if you get sick first" conversation because it feels pessimistic, and so they default to whatever the agent recommends. Rational preparation isn't pessimism. It's the financial equivalent of wearing a seatbelt on a sunny day when you have absolutely no plans to crash. At the end of the day, joint life policies aren't inherently bad products, they're just frequently mismatched products sold to people who needed something different. Like most financial tools, the answer isn't yes or no, it's it depends. And the discipline is in doing the boring work of actually figuring out what it depends on for your specific situation. Insurance is ultimately about transferring risk you can't afford to carry alone, and whether you do that jointly or separately matters far less than whether you do it at all. The worst policy is the one you never bought because the conversation felt too complicated or too morbid to finish. And if you're trying to figure out how all this fits into a bigger financial picture, including real estate investing, home contracting work, or finding the right lenders, check out our links in the description below, and let's get you started.